Hey everyone, welcome back to Corporate Decoder, the place where we decode the business world's secrets. Today we're diving into Cummins' latest report, Get Ready, because it involves lots of borrowing like someone who just discovered credit cards. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more discussions. This report is all about Cummins taking out new credit agreements, basically loans, to keep their operations running smoothly. We're going to break down what these agreements mean, how much money is involved, and what it could mean for the company's future. We'll skip all the boring legal stuff and focus on the key details that matter to you. First off, this is a Form 8K filing. This is a report companies file with the Securities and Exchange Commission, or SEC, to announce major events. Think of it as a corporate breaking news alert. In this case, the news is about Cummins securing new credit agreement. The date of the report and the earliest event reported is June 2025. This is when Cummins officially entered into these new credit agreements. The company we're talking about is Cummins Inc. They make engines, power systems, and related parts. You've probably seen their engines in trucks, buses, and other heavy-duty vehicles. Cummins is based in Columbus, Indiana. That's where their main executive offices are located. Now let's get to the heart of the matter. Item 1.01, which talks about entering into a major agreement. This is where Cummins details the new credit agreements they've signed. Cummins entered into what they call a third amended and restated credit agreement, or the 5-year credit agreement with several lenders and JP Morgan Chase Bank NA acting as the administrative agent. Basically, JP Morgan is the middleman managing the loan. Under this 5-year credit agreement, which matures or ends on June 2030, Cummins can borrow up to $2,000 billion. This money can be used for revolving loans, which are like credit lines, swing line loans, which are short-term loans, and letters of credit, which guarantee payments. This 5-year credit agreement replaces a previous agreement from June of the previous year. It's like upgrading your phone, but with billions of dollars. In addition to the 5-year credit agreement, Cummins also entered into a 3-year credit agreement. This agreement matures on June 2, 2028. Under this one, Cummins can also borrow up to $2.1 billion. Again, this can be used for revolving loans, swing line loans, and letters of credit. The 3-year credit agreement replaces a previous agreement that expired on June 2, 2025. These short-term loans were amended and restated 6 times before they were finalized into the new 3-year agreement. Importantly, these borrowings are not secured with liens. This means Cummins doesn't have to put up any specific assets like buildings or equipment as collateral. It's more like an unsecured credit card than a mortgage. Cummins guarantees all borrowings by its subsidiaries, meaning Cummins is responsible if its subsidiaries can't pay. Cummins has the option to increase the amount they can borrow. They can add up to $1.0 billion to the 5-year credit agreement and another $1.0 billion on time, and they need the lender's approval. The interest rates on these loans vary depending on the type of loan, the benchmark rates at the time, and Cummins' credit rating. Cummins can choose from different interest rates, including the alternate base rate, the term SOFR rate, and others. The interest rate depends on Cummins' credit rating. Currently, it's rated A2 by Moody's and A by Standard & Poor's. This would result in an applicable rate of 0.75% under each credit agreement. A higher credit rating typically means lower interest rates. It's like having good credit and getting a better deal on a car loan. It's important to remember that credit ratings are not recommendations to buy stock. They're just an assessment of how likely Cummins is to repay its debts. The credit agreements include certain requirements or covenants. One of these is a financial covenant that limits how much debt Cummins can have relative to its total capital. Basically, they can't be too leveraged. The ratio of net debt to total capital can't be greater than 0.651. Item 2.03 simply refers back to the information in item 1.01, incorporating it by reference. So what does all this mean? Cummins is securing a significant amount of credit to fund its operations and growth. The terms of these agreements, including the interest rates and covenants, will impact Cummins' financial flexibility and performance. Now let's put on our Warren Buffett hats and analyze these moves. Cummins is essentially betting on its future growth by taking on more debt. Whether that growth will materialize as expected is the big question. It all comes down to how well they manage their debt. On the one hand, securing these credit lines provides Cummins with financial flexibility. They can invest in new projects, make acquisitions, or weather unexpected downturns. On the other hand, taking on more debt increases their financial risk. If their business slows down, they could struggle to repay these loans. The fact that these loans are unsecured is a positive sign. It suggests that lenders have confidence in Cummins' ability to repay. However, it also means that Cummins doesn't have as much bargaining power if things go south. The financial covenant requiring a debt-to-capital ratio of less than 0.65 to 1 is a good thing. It forces Cummins to maintain a healthy balance sheet and prevents them from over-leveraging. Overall, Cummins' decision to enter into these credit agreements is a calculated risk. It could pay off handsomely if they can continue to grow and generate strong cash flows. But it also exposes them to greater financial risk if their business falters. Alright, that's our breakdown of Cummins' latest credit agreements. What's your take on these borrowing decisions and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching and see you next time.